Good morning. We're half an hour from the opening bell in Hong Kong with mainland China still on the Lunar New Year break. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins. It's only Monday, and here we go.
We're ready. We're ready for the week. Our top stories today. Asian stocks and U.S. futures fall while the dollar and oil surge after President Trump carries out his threat of tariffs on China, Canada and Mexico.
Investors are bracing for a trade war with cars, clothing, food and liquor in the firing line. China vows countermeasures while Canada unveils retaliatory tariffs, and Mexico is set to announce its response later today.
And Chinese stocks in Hong Kong are facing pressure when trading reopens today, with online retailers, chip makers and green energy stocks vulnerable to those tariffs.
And we're live in Mumbai as investors digest India's spending plan, including $12 billion in tax cuts to boost economic growth. Good morning from the Asia Pacific. That's the only good thing really about what's taking place right now. We've been forced out of bed. My brain is still half asleep, so bear with us for the next few minutes or so. As we get warmed up today, these markets are really giving us something to wake up with, really. As my lack of caffeine is indicative really of where I am here. A50 futures are coming online in Singapore, down 2.7%. So going into the reopen of Hong Kong today, brace for substantial losses. Although I should also mention that we're coming off a little bit as far as U.S. futures go, down about 100 points. Asia Pacific, all things equal, 2.3% to the downside. All right, flip the boards. And the market that is in focus at this very minute is Taiwan. It's reopening after being shut for a week. And the TAIEX index is up by about 4%. TSMC in line with the drop in ADRs last week, down about 6%. So two things are happening, the broad risk aversion plus the market's repricing, of course, on the DeepSeek conversation, which, by the way, seems like a universe ago, given all the news on the weekend. Treasury markets, 2, 5, 10, and 30. Yields on the short end are pushing to the upside. On the long end are slightly to the downside right now. And the story across FX markets is really one of risk aversion. Dollar is up against everything else except the Japanese currency. Well, the Japanese currency is now weaker right now. I take that back, 0.4%. Dollar China extremely close to that record low on the offshore rate, to be more specific. And, of course, the other currencies in focus, including, by the way, and at some point, I would imagine we'll be talking about the euro very, very soon, with the U.S. president now also saying that tariffs on Europe are on the table, definitely.
Yeah, that's right, Dave. And as you say, really the agenda for today all focused on the impact for markets when it comes to tariffs. We really are trying to weigh and see precisely what it's going to be. The surprise something is that we haven't seen carve-outs particularly. So this is perhaps a broader-based measure than we were expecting. Other than that, still the currency, as you mentioned, the offshore yuan under pressure there. The level that we're watching is whether it goes above USD CNH 7.3749. If we see that higher, that will be a record low for the offshore yuan. We potentially could see some kind of intervention in the Hong Kong market via the PBOC. Onshore markets, of course, still shut today. And you were sort of hinting at this earlier, but we're trying to reconcile these two different things going on. On the one hand, we had this incredible development when it came to DeepSeek, upending US stocks last week. At the same time, Chinese stocks haven't been able to react to that positive news. But, of course, we also have now this tariff headwind too. And then a bit of data, flurry of data, in fact, that we're expecting to come out. Tyson, China PMI numbers are going to come out. We think there may be a negative surprise there, contradictory signal according to Bloomberg Economics, as well as some retail and GDP data coming through from Hong Kong.
Yep, so it's going to be extremely busy as we make our way, of course, into the open today. We're looking at futures right now pointing to the downside, so the Chinese markets might not even need to react to the AI conversation, given, of course, the tariff developments out on the weekend. Let's have more on the story right now and what it means for the U.S. and its biggest trading partners. Bloomberg Economics had put out this note, in fact, if you just want to sort of justify and sort of quantify, rather, what this might actually look like. So it impacts nearly half of U.S. imports if you take the 2023 numbers in focus. It may knock off that amount from GDP. It could add that amount to core PCE. It already considers any sort of offset and retaliatory measures coming through out of its trading partners. And I think the headline says it all. A significant supply shock to the U.S. economy is what we're seeing here right now.
I would just add, there's a couple of interesting points here. That 1.2, that model depends on whether or not those countries react in kind.
That's right.
And so Canada, yes, perhaps. Mexico, yes, perhaps. China, probably we're not going to see that dollar for dollar reaction there. So there's a little bit of a caveat. And I just did a little bit of back of the envelope maths here. But when we're thinking about now where average tariffs lie for the US, BE estimate is that this is taking it up from 3% to 10.7% for the US average tariff. Now compare that to China, now 7.3.
Wow.
I don't know if it's the first time where we've seen that big differential, but it certainly is a big shift here, just to put those big kind of dynamics in play.
So for a moment there, I was thinking, okay, are you flipping those two countries around? And, the Chinese response has been one that's political, that they needed to come out. Yeah. And interestingly enough, they're taking this to the WTO, which I guess to your point earlier on, might actually be the first time since China entered the WTO 2 decades ago that this, the tables have actually flipped. We did hear, by the way, from President Trump. He spoke a few minutes ago about his plans on tariffs on the European Union. Here's what he had to say as well.
It will definitely happen with the European Union, I can tell you that, because they've really taken advantage of us. And, we have over a $300 billion deficit. I wouldn't say there's a timeline, but it's going to be pretty soon.
Let's get the very latest from our global economics correspondent, Enda Curran in Washington. Enda, thank you for joining us. Just tell us some of the details of these tariffs, Canada, Mexico, versus what we're seeing happening to China.
Yep. Good morning, Rebecca. They are far-reaching in their breadth. They push well beyond the scale of what we saw back in, if you want to call it, Trade War 1.0. The 25% tariffs on both Mexico and Canada will cover food, agricultural produce, clothing, obviously autos and auto parts, lumber, and of course energy. Now on the Canadian side, there was a little bit of reprieve in terms of the tariff coming in at 10% on oil imports from Canada. Now on the China side of things, the tariff is at a lower level. It's at 10%, but it's universal. It's on everything coming in from China. And the president has targeted the de minimis threshold of $800 below being tariff-free. This has been a talking point for many years, and he's taking a look at that now. So taking it all together, economists are saying that raises question marks about the impact on inflation. If you're having tariffs at that level on consumer goods, it may flow through to households. They're questioning the impact it will have on growth. Depends how business confidence and business sentiment responds in terms of their investment decisions. And of course, then you get into the world of retaliation from all trading partners and how that plays out in all economies as well. So it's early days in this dispute. We don't yet know how all of this will play out and impact, but right here, right now, it's pretty serious signals from the White House and lots of question marks over how this will impact all economies.
Yeah, and we're taking this almost hour to hour, day to day. So we've heard from clearly the White House. We've heard from Justin Trudeau. What are we expecting to hear from Mexico today?
Well, Mexico are playing. It seems like they're playing something of more careful hand in terms of how they respond to President Trump. They've certainly been very clear and vociferous that they don't accept the charges around that they're not doing enough to control the flow of fentanyl. And they have made the case that they're willing to come and talk to the president and see where they can do what needs to be done to make a deal with him. But at the same time, they have promised to retaliate, and those measures will be coming, or at least will be announced on Monday morning. Canada has already put in place the first phase, at least, of their kind of dollar for dollar tariff response that they're advocating, and that's targeting key states around the US where there are key Republican senators, for example. So they're getting straight into their response. And this is the interesting part of it, is that the executive order that came out over the weekend includes a clause that the US will retaliate against any retaliation. So by all accounts, it's setting it up for something of a very protracted dispute between these trading partners. And remember, this is over fentanyl and illegal immigration. It hasn't yet of course, got on to thorny negotiations over the merchandise trade deficit between these three nations that President Trump speaks about all the time. And there are other subplots within this over, for example, NATO spending on the Canadian side. So by all accounts, I think it looks like we're at the early stages of what's going to be a fairly protracted process, I think.
Global economics correspondent Enda Curran in Washington there for us. Let's now bring in our chief North Asia correspondent, Stephen Engel. Tell us, Stephen, what is Beijing saying so far? Relatively restrained reaction.
Yeah, and I agree with Enda. Obviously, this is going to be a protracted process, so Beijing has to process exactly what's going to be the end result of tariffs. Is it going to go up to 60%? It's 10% right now, and there's going to be an economic impact of that. And I think right now, especially as they're coming out of the long Lunar New Year holiday, kind of crafting their message, obviously. We did hear from the Commerce Ministry expressing their strong dissatisfaction. Not a terribly strong word, strong dissatisfaction. My wife tells me that all the time about my daily chores, right? But, again, they could get a lot, more vociferous on this front. They also vowed corresponding countermeasures without elaborating again. And again, they said they're going to take this complaint to the WTO. But again, how much efficacy is in that move when the Trump administration is said to be acting fairly unilaterally in that? They could also play with the yuan fixing. We've been talking about the offshore possibly hitting that record low. That could help cushion the blow for its exporters, obviously. But more likely, since they can't compete tariffs like for like because the imbalance of trade, you could see potentially more export controls on critical minerals. You could see market access restrictions on some American companies. And again, there could be some specific tariffs of their own. But again, how much tit for tat spiral do you want to go that would hurt China's own recovery? No doubt.
And as far as the fentanyl, China being the source of some of the precursors, how might they be able to respond to that?
Well, that's what we're waiting for, to see how far they can pledge to go to combat a problem they've never publicly acknowledged that they are allegedly causing, right? So, yes, Joe Biden and Xi Jinping in San Francisco on the sidelines of APEC did talk about combating this issue. Xi Jinping made certain pledges to combat it, but without, again, necessarily acknowledging that the chemical companies in China are producing the precursors and potentially, allegedly sending them to, among others, the drug cartels in Mexico. He has near absolute control, Xi Jinping does. He could potentially do something, but does he want to do it in this frame? As far as responding to a unilateral move of tariffs on China? Probably not at this point. I still think Beijing is going to take a much more measured approach. One way that the United States, and Enda mentioned it, is about this de minimis $800 package that both Biden administration and Trump administration are looking about abolishing. That's essentially, you can go duty-free and inspection-free packages direct from China to the United States of $800 or less. Yeah. This has helped Alibaba, it's helped Temu, it's helped Shine do direct to consumer. But what the Trump administration is also saying is it's allowed potentially the precursors to be sent in small packages but in mass quantities to the United States without inspection. So that is something that review is going to be completed by April 1st. That could be an avenue that the Trump administration will take to cut off that precursors if it is indeed happening.
Okay, Stephen Engel, our chief North Asia correspondent. Just about, 60 minutes of the opening bell. We're off 3% here on Chinese futures. And just on Steve's last point, we have the perfect guest coming up in about 20 minutes or so. Goldman Sachs head of Chinese internet is coming on to talk us through what tariffs mean actually for e-commerce as well. A big focus, of course, particularly given all the news flow we've seen. There's also the other angle of DeepSeek and what that means for that group of stocks. So stay tuned for that interview with the head of Asia Internet Research at Goldman Sachs.
But first, the US dollar is surging in early Asian trading. Standard Chartered Bank joins us next as we track the impact of the Trump tariffs on the currency markets. And we are counting down to the open of trade in Hong Kong. You're looking at these live pictures from the Hong Kong exchange for the first trading session of that year of the snake. We'll see whether there is much to look forward to as markets have the first opportunity to digest all of this Trump news. This is the China Show.
Right, welcome back. So we're looking ahead to the Hong Kong reopen today. Mainland markets are still shut. It's probably a good time to be shut, really looking at the price action out there. We're off by about 3% on A50 futures. It's really about tariffs. It's really about markets pricing this risk back in a very big way this Monday. The dollar is up substantially as we speak. So as we came into the office this morning, it was almost picked the currency that's really off by the most. And yeah, by most accounts, it's really everything else.
We came in just trying to digest this news about Canada, Mexico. Of course, we saw big changes in the dollar there and the various currency exchanges. But then no sooner had we sort of started to make sense of that, we had this news that EU tariffs could be coming very soon. We have quite robust language from President Trump on the tarmac saying that he's really unhappy with the trade deficit and so on, and the openness to trade and US exports not going into the EU and so on. And so I wonder if today also we shift this focus to also be thinking a bit more about what happens with the euro, rather.
Yeah, absolutely. He could not be more definitive as far as that was concerned. In fact, the phrasing there on the tarmac was concerned. And on top of that, too, Mexico has said it will respond Monday. So we're keeping an eye. We're really on headline risk as far as FX markets go. On the dollar note, we're up 1%. Let's bring in Stephen Englander, global head of G10 FX research at Standard Chartered, joining us right now from New York. Stephen, a pleasure to have you on the show, and sorry to bug you on a Sunday. The news gods are raining heavily on us today. Why don't we get started with the dollar? What's your sense of how much further the dollar can strengthen short term here?
Well, let me say, it hasn't been much of a Sunday for me either, or a Saturday. Look, I think the market's still digesting what's happening here. I think that there was a sense, especially after last week with the on and off Colombia tax, that Trump wanted to use them as a negotiating ploy. But he seems to be like a poker player who's betting his whole stash on the first hand, not sort of feeling out the table to see what's going. And it, the market just wasn't prepared for it. He sort of really hammering Canada and Mexico, their two biggest trading partners, doing some damage to China. And I think it was clear the only reason he didn't include Europe was he couldn't find a national security argument for including Europe, but he'll find some other reason to add tariffs on Europe. So I think the market's seeing this as full-scale risk off and much worse than what was anticipated.
Stephen, I want to ask also, how does this exchange rate differential between the currency, between the US dollar, how much reprieve does that offer China when it comes to these 10% tariffs?
Well, it offers it some, right? When at the beginning, say when the Trump odds started going up at the beginning of October, dollar CNH was around 7. Now it's 7.5. So, there's a 5% depreciation there off a 10% tariff, on some goods. So it does give them some help. The other advantage, say, that China has is that it has, diversified trading partners, unlike Mexico and unlike Canada. So, and they've been diversifying for a couple of years now. So in some ways, they're in a better position than the other countries that Trump is kind of tariffing up.
Stephen, yields are pushing higher. Is the market pricing in the inflationary impact here? And how does this affect the Fed's easing cycle? I believe you still have one cut penciled in for March, if I'm not mistaken, Stephen.
Yeah, look, I think there's a lot of fear here, but let's talk about what the market is doing, and then we can talk about what we're thinking. What the market is thinking is that if he's doing tariffs, it's because he wants the revenues to enable tax cuts. And so the market sees not just more inflation or higher price level from the tariffs that translates into short-term inflation, but it's also seeing fiscal stimulus down the road. So it says, okay, which way are yields going? And, they're going up, and, the yield curve is steepening as a consequence. We think the economy might hit a pothole and that cuts are still on, but obviously, both we and the Fed have to factor in the new developments.
Yeah, Stephen, the risk that and we're obviously taking this almost headline to headline, minute to minute. What about the risk that Trump's team reverse course in this? Is that something we should be thinking about if some of the economic sort of benefits aren't pulled as quickly forward as they had once hoped?
I'll tell you that's a pretty fat tail. I mean, a lot of this dollar strength is U.S. exceptional. If it turns out that this doesn't work, that tariffs are very disruptive, that exceptionalism story goes down the drain, and we're just in a world kind of where everybody has a bit of stagflation. That's not what equity markets are priced for, and that's not what anything is priced for at this stage.
Stephen, again, thank you so much for joining us on your Sunday. Stephen Englander there, Global Head of G10FX Research at Standard Chartered Bank. Just under 8 minutes, 7 minutes, in fact, to the opening bell, reopen here in Hong Kong. And yeah, I mean, if you're long these markets, one thing to do, close your eyes. This is the China Show. Welcome back. Just under 5 minutes of the open, reopen. Okay, it's getting interesting. So here's the thing. So you have this deep risk aversion taking place across these markets, no pun intended, on what's coming next. Although, as you can see, we're not actually doing as badly compared to the rest of other markets right now. And this might actually be down to this offset that we're seeing across some of the DeepSeek related plays here. Yeah, really interesting. I mean, obviously markets were not open to try and, let that news sort of provide any kind of bump up. It was highly disruptive for US equities. So perhaps not a surprise that we are now seeing some of this DeepSeek, the advancements that we saw in their new release model coming in. Of course, the first major open source AI model of its kind that really sort of threw and seemed to throw so many US AI providers kind of off their beat a little bit. Yeah, a wrench and the horse's carriage, as they say, into that. It wasn't also DeepSeek, or only DeepSeek. So Alibaba also came out with their cloud unit, actually came out on Lunar New Year's Eve with their own version of that. As you can see, up 5% as far as that is concerned. So we'll continue to track that. In fact, in a couple of minutes, Goldman Sachs head of Chinese internet will be coming on to take us through this. Very quick glance at some of your semis, and yep, it's playing out as far as these guys are concerned. Hong Kong listed energy shares, big pop in energy prices. Globally, we're getting the opposite effect there. And the risk aversion in your markets globally this Monday, we will look at that. 3 minutes to the opening bell. Welcome back. You're watching the China Show. On your left is, of course, Paul Chan. He's speaking at the reopening ceremony at the Hong Kong exchanges as we sort of usher in and sneak into the year of the snake. And it's interesting given the juxtaposition we're seeing across the global markets, and somewhat, we've been reminded of this time and time again, somewhat of an uncorrelated asset. Chinese assets and markets have been and sort of served for your portfolios, and that's playing out to some extent, right? So you have this tariff news really poleaxing risk assets, including Hong Kong. Not as badly, though, because there is a DeepSeek offset that's playing out as far as the Alibaba is concerned. A couple of markets that have come online this hour. You have Singapore, Malaysia, we're off there. The Philippines was actually down 4%. On Friday, so that's actually seeing a little bit of upside right now. That market entered a bear market, keep in mind, on Friday. On your screens, just to mention that too, is Bonnie Chan, of course, who is the boss at the Hong Kong exchanges. Let's have a look at currency markets. Yeah, there we go. Dollar Canada, high since 2003. I believe it's also overbought when you look at some of these momentum and technical indicators, but I guess is today a day where you start looking at that? Maybe not. Dollar Japan, 0.4%. And the open here in Hong Kong, can we get that up, please, if we can? So Hang Seng Index actually was trading at about a 3-month-ish high going into the long weekend. So we're down, not bad actually. This seems like a normal day, but you know, the night is young, right? 0.9% on the HS Tech Index. To the point we were making earlier on, Rebecca, right? There you go. Alibaba, bottom of your screens, is up 3-4%.
Yeah.
And this is down to the DeepSeek conversation that rattled U.S. markets last week.
Yeah, absolutely. And I think maybe something of a surprise, given how much the tariff conversation has really dominated, particularly on the FX currency story that we've seen so far. Just to help us understand what we're seeing when it comes to DeepSeek, artificial intelligence, the internet space in China, let's bring in Ronald Keung, Head of Asia Internet Research at Goldman Sachs. Ronald, I mean, let's kick off with what we're seeing, a little bit of this offset, it appears, at least maybe for the Seng Index. Alibaba still up around 4%, I see. To what extent have we already seen sort of the benefits of the DeepSeek advancements playing out? How much more upside do we have?
Sure, thanks, Rebecca. I think over the past week, basically, we had multiple models. So it's not just DeepSeek, it's actually multiple models. 5 of those, at least big ones, have announced by Chinese players. And of course, investors have been talking about, is it a US model versus Chinese model? Actually more, there's a debate, is it open source versus closed source? And I think for AI, the key two kind of obstacles in proliferation of that over the past year is cost, and is it smart enough? And over the past week, we've seen these models that have improved themselves through reasoning, through actually going through the reasoning process, how they think before they speak. I can say human beings, we think before we speak. And in the past...
Well, hopefully. yeah. Not for all of them.
That's what we strive for on this show.
Yes.
And over the past year, we've seen chatbots just give you the answer split seconds. Now they think and tell you what is the thinking. So that's really the strength of being smarter. Then they get better results from these AI models. And the other is cost. Have they thought about how to make the cost lower? And Chinese players, we think, due to some of the limitations in computing powers, we've seen them focusing not just on the performance, but also on cost. As these AI models get smarter and the cost comes down, we think this year, U.S. team and our team over in Goldman Research, we expect a proliferation of AI applications and agents. And this is how, from virtual pets to chatbots to applications that helps you in studying, all of those, as the cost comes down per token, we think the proliferation year is 2025, the proliferation.
Just to follow up on that point, so if it's not a story about US versus China, but instead a story about kind of innovation, really expensive innovation on the one hand, and kind of more low cost, perhaps we can call it best practice models on the other, is that kind of bifurcation, I mean, to what extent does geopolitics still play into that, I suppose? Because we still have this big question mark of chips access. So I guess if it's not US versus China, where does the geopolitics come in?
So we see 5 overarching themes for China Internet, but for theme 2, the growth of AI agents, applications, but at the same time, theme 3, which we highlight, is geopolitics. And so you still have the balance between could the Chinese players get the computing power, the chips. At the same time, this will impact their capex, which is theme 5, the balance between AI capex and shareholder returns. And so I think the overall is how do these companies balance the innovation while open source helping to develop different models. As I said, 5 models were launched. A few of those are open sourced. And this open source means many people will learn from these open source, and the open source community with developers develop more. And so helping each other in open source means driving better and smarter models, and then at the same time driving lower costs.
You mentioned the conversations that you guys are having with your U.S. colleagues, and does it seem like the containment efforts from the U.S. side are having not a political answer, but having the intended effect on the runway that we're seeing for a lot of these Chinese players? Because you mentioned it's not just DeepSeek, right? We've had a number of models come out. It's almost a reminder that they haven't worked. That's an open question, I guess.
It's evolving as we see geopolitics as the key theme, one of the key 5 overarching themes for China Internet. And I think for that front, we've seen a lot of the Chinese apps have come on board into the top downloads. Just over the past month, we've seen TikTok, we've seen RedNote, we've seen all of these companies moving up into the top downloads. I think it's just the innovation and how these companies in China has been building on efficiencies. We've seen the cost optimization over the past year or 2, driving better profitability on cost controls. And I think the innovation still continues, no matter it's from we see super apps in China. I think this is one of the innovations that across the world, the super app in China has payment, has instant communications, video, short videos, now transactions as well. And so in the key theme, one of the overarching themes is how these super apps are moving more and more into transactions as well. And as they go into the SKU levels of data, then your instant messaging, your short form videos in WeChat, that drives also transactions, and that brings on competition. Therefore, we see competition, AI, geopolitics, and domestic policy stimulus. These four are the key swing factors for our China internet sector.
Do those factors address the monetization concerns? Do you think at some point will the technology be a massive revenue generator?
I think on monetization, first is the existing businesses. So this year we expect a lot of our platforms to support SMEs.
Okay.
I think we have very strong profit growth in 2024 for across our platforms. And for this year, we expect a more flattening of what we call a GMV margin or profit margin on the domestic businesses. But yes, on cloud and hyperscalers, our businesses have built a cloud business across computing. And so at hyperscalers, we do think they will benefit from a proliferation of AI applications. But at the same time, of course, AI applications are moving partly more on hyperscalers, but also on edge on your phones.
Yeah.
And so this is the fine balance as the whole AI moves from training to inference, how these applications drive demand from both big data centers, but also more computing on your phones.
I just want to follow up on some of the tech consumer names. There is this concern that tariffs are going to weigh, particularly when it comes to removal of this de minimis exemption, essentially allowing sort of duty-free goods packages that are valued at less than $800. That's a pretty hefty chunk of exports that are coming from companies like Temu and Shein and so on. How much of a hit does a 10% tariff, the removal of a de minimis, how much of a hit is that to some of these Chinese companies?
Yeah, so we've written very extensively across kind of tariffs and de minimis. I think the key is does that apply to everyone? And the essence of online models is a direct shipping from manufacturers to end consumers, just fewer layers, and that's how Amazon, that's how e-commerce businesses in China. And therefore, if it's applicable across everyone, then the cost base moves up, but it doesn't impact a single player. And we have to still continue to monitor the developments, as we call this, is the geopolitical overarching themes, a lot of evolving things that happens across tariffs, across apps and operations in the U.S., data security, all of those. So this is still a highly evolving situation.
I think we're moving into earnings season here in Greater China in a couple of weeks. Just what are the top themes, apart from this, that you're tracking there?
Yeah, so I think the fourth quarter, December quarter, will start to kick off the result season from late Feb, and then the core key companies reporting across March. We expect a pretty solid December quarter. There's also some of the better than expected consumption trends in December. Versus November, there was actually a big pickup in appliance sales, and then communications like mobile phones also has had some pickup. I think it's partly on the Chinese New Year that we've just been through. I think a bit of consumption that was front-loaded a bit in the last week of December, but also the domestic consumption policy stimulus. That's why what we're preferring this year, at least for the time being, with all of these noise and geopolitical situation, is we prefer domestic consumption stimulus-focused position in China internet, plus some more defensive like games. I think that's how we like our preference. And heading into the result season, we also expect domestic policy stimulus leverage company in appliances, in electronics. Those retailers will benefit more with a more solid December setup and into 2025.
Yeah, we've been forced into work this early in the year. Everything from AI, tariffs, and soon enough, earnings. Ronald, thank you so much for coming in. Ronald Keung there, head of Asia Internet Research at Goldman Sachs. On Chinese tech, laid it out quite nicely there, the themes to watch. From one Goldman note to another, so just to mention here as well, the good folks at Goldman Sachs put out this on the economic side of things, and back to the tariff impact, right? Just they're thinking of how initially we might see this play out from a policy implication perspective. So if the 10% tariff increase, if it stays, and their base case is still 20%, so it's still lower than that, it would reduce growth by that much, put downward pressure, modest downward pressure I think on the current on inflation, and flip the page, please. The next page actually tells you everything as well. But it might mean that the PBOC will need to emphasize and prioritize FX stability ahead or instead of monetary policy.
Right, this whole question of whether or not it limits the amount of room that the PBOC has to move here when it comes to the Chinese economy.
Yeah, there we go. Okay, how many stars have we gone through today so far? I'm counting 1.5 million right now. TSMC, that's the other angle. So everything that's going on right now. So Taiwan markets are just coming back online after being shut for a week. We're off by 4% on the benchmark. We're coming off a little bit right now on the stock itself, down about 6%. Let's bring in Winnie Su, our Asia equities reporter, who's been tracking this actually for us from last week into this reopen we're seeing today. And yeah, Winnie, are we surprised that it's doing as badly or not as badly as we think, or as we thought?
I would say probably not as badly as we think. Like you mentioned, it dropped about over 6% at the open when the market came back from the Lunar New Year holiday, and that was almost the most since the August meltdown. But it has kind of come back up a little bit. Yes, we're facing the kind of the aftershock of DeepSeek that Taiwanese market was able to avoid last week, and just like we saw last week on Friday, SK Hynix was actually down 10% when South Korea market reopened. So it's not that surprising that we're seeing some sell-off in the TSMC shares. And also just to note, like we're seeing with the tariff risks right now, although it hasn't really mentioned semiconductors yet, just the tariffs around China, around Mexico and Canada. We saw in one of the notes from Morgan Stanley saying that they are still quite cautious around that area, expecting some more tariffs to come. So with both the tariffs and also the news around DeepSeek, it is not a big surprise that TSMC is under pressure and hence pressuring the Taiwanese market that pretty much relies on TSMC for 40% of the moves in the stock market.
And Winnie, when it comes to the Hong Kong reopen, is there anything that stands out to you or has taken you by surprise at all?
Yeah, so actually we just saw the Chinese shares in Hong Kong opened just now, and it was down about 1%. So yes, it's down, and people were expecting that stocks would go lower because of the tariffs on China. However, it actually still outperformed the overall weakness in the region, and people are saying that because the 10% tariffs, it's not really something new. We've heard about it already, and just a milder tone from the Chinese authorities. And with the tariffs coming in, potentially we are going to be able to expect some more stimulus from the Chinese government ahead of around March with the 2 sessions. So that is giving some hopes for investors, and also with the advancement in some of the Chinese technology shares, with Alibaba, talking about its AI advancement. That's also helping Chinese shares a little bit compared to what we saw in the Taiwanese and in the Korean tech shares.
Okay, Bloomberg's Asia equities reporter Winnie Su there from Tokyo. There is plenty more ahead. Stay with us. This is Bloomberg.
Right. Cash markets in the Asia Pacific are off by that amount, 2.5% right now, as most markets have come back online. Mainland China, of course, is still shut for Lunar New Year, and it's shaping down to be a really bad session coming up here as far as Europe is concerned, and also the United States here, we're off by about 100 points on S&P futures. So if you're looking to call in sick this Monday, it's not too late to do that if you don't want to participate in such a down day. We're looking at Nifty futures as well. Of course, we did get the budget, of course, on the weekend, 0.7 to 1%, but I would imagine that, among other things, are taking a back seat today with the tariff conversation. Right. Breaking news and breaking numbers coming out of China. The Taishin PMI numbers are out. It's quite a big miss, actually, 50.1. Still above 50, but we were looking for a median of about 50.6 here, and still quite a drop there, as you can see from the previous month. But as you see on your screens, this data and other things are not as important on a day like today.
Yeah, Trump tariffs really sort of dominating today. And here are some of those big top geopolitical stories that we are following. The US aid website went offline over the weekend as the Trump administration reviews its future. Sources say some officials at US aid were also placed on leave after denying staff from Elon Musk's Department of Government Efficiency access to systems, citing lack of security clearances. This follows a President Trump executive order to halt and reevaluate US foreign aid. And President Trump's tariffs against Canada and Mexico are threatening production for automakers across North America. The duties may immediately hit almost a quarter of the 16 million vehicles that are sold in the U.S. each year. Wolf Research analysts estimate it could raise the average price of a new car by about $3,000.
Right. Let's continue the tariff conversation here and what this means, say, for the Chinese economy. Bloomberg Economics say that this 10% increase in the U.S. Levy on Chinese shipments may actually have a muted impact initially, but Beijing's vow of countermeasures then, of course, raises the stakes and makes this a little bit more uncertain as you extrapolate forward. David Chu, our economist, is with us here on set to take us through your initial thinking here.
Well, first of all, we think it comes earlier, much earlier than our expectation, because our original thought was that it should be launched in the end of the second quarter or in July, so that on the schedule side, it's much earlier than expectation. And it also tells us that maybe the situation is more tough than what we thought.
I want to ask also about the fentanyl mention. To what extent is the focus around fentanyl a potential off-ramp for Beijing? What could Beijing sort of offer to try and offset some of that 10% tariff hit?
Yeah, I think on this side, we talk about two things. One is the retaliation, but we think that retaliation is not the first priority for China now. The first priority is how to support growth, so that we think both the monetary policy and the fiscal policy could be more eased. And we have called the PBOC to continue to cut the RRR and policy rates this year. And we think it may come, in the next couple of months for the monetary policy side. And for the fiscal side, we are expecting a 8.5% GDP deficit ratio, which is 1.9 percentage point higher than last year. What we are talking is the broad deficit ratio. So, but this can only be fixed in the People's Congress, which is to be held in early of March. So between this today and the People's Congress, we think the PBOC can take some actions.
Goldman had an opposite view. They think tariffs, if they remain, limits the PBOC's ability to deliver easing because they're focused now on currency stability.
Well, I think the PBOC need to balance between the two. One is how to support the economy, and the two, how to stabilize the yuan. But to be honest, we think now the priority is the economy itself, because if you don't ease to support the yuan, you will have a weaker economy, which will exert the downward pressure to the yuan as well. So that it comes to one thing, you have to support the economy.
Bloomberg economist David Chu there. Will be all across the tariff story over the next hour or so. Stay with us. There's plenty more ahead. This is Bloomberg.
Right, welcome back. Look at markets right now. So as you can see, these are actually I can count them actually in one hand. I'm just looking at my screens right now. The few bright spots in this Chinese market, the DeepSeek repricing taking place, Alibaba and SMIC, of course, still feeling the tailwinds. Apart from that, though, it's very difficult to see what else is still benefiting from the pixie dust from last week's developments there. Because apart from that, though, of course, there's a tariff conversation that wedged itself between on the weekend. In fact, some of the e-commerce plays, EV plays in focus. There you go on your screens to a point we were making earlier on. Declines there. And yeah, this is consistent with declines we're seeing in equity markets. And we'll leave you with a look at the damage in these markets currently. Okay, welcome back. Not a lot of good news out there. So, well, it's a beautiful morning in Hong Kong, though figuratively, literally, if you zoom out, this is what we're seeing. And really, on a day like this, I like this analogy that this is the visual iteration of having your nose hair pulled. Oh. This is really that. If that had a market visual, it's this next board that's coming up with Asia session lows, U.S. futures, European futures, and going into the India session, where, by the way, there's a very important budget that they laid out in the last, 24 hours or so. That's also going to take a back seat, I guarantee you, looking at a market like today. MSCI Asia Pacific is off by we're now off 2.6%. Broad-based sell-off. A lot of it is really in growth-related stocks. Do we have the board, please? Can we flip? Thank you so much. Not this. Do we have the S&P board, please, if we can? No, it's too late for that. Let's move things along. This is the currency market, and yeah, 2% from parity, very close to all-time lows in dollar CNH to be more specific. And of course, as we mentioned this early on, some of the tech plays, SMIC, Samsung, SK Hynix, and I believe you should have TSMC here. Please have TSMC in there. Anyway. No, we don't. Okay, anyway, TSMC's down about 5-6%. Anyway, let's get the latest here on the top stories today, Rebecca.
Yeah, for the latest on these tariffs and what we're seeing and how they're playing out in markets, let's bring in our team. Jill Desis is our news desk editor. Also with us is our Chief North Asia correspondent, Stephen Engel. Jill, I'll start with you. Are we really surprised by what we're seeing today? And what has caught you by surprise?
Well, at this point, I think part of the surprise just kind of lies in the continued uncertainty over these tariffs, right? At this point, obviously, we're expecting these to go into effect, I believe, Tuesday, U.S. time. But it does seem like there's still a lot of jitters over what exactly the retaliatory efforts, for one thing, ultimately look like. The fact that there's tariffs obviously aren't a surprise, given that Trump has been telegraphing this for about the last 6 weeks or so. He said that he was going to impose 25% tariffs on Canada and Mexico back in December when he was still president-elect, and we did get that hint of these China tariffs, just a few weeks ago as well. But at this point, we've already heard from Canadian Prime Minister Justin Trudeau on additional retaliatory efforts that Canada's putting into effect. It sounds like we're going to be getting something from Mexico potentially on Monday, some further detail there. China has been a bit more muted, but obviously we're in the middle of this Lunar New Year holiday, so we'll have to see how that ends up shaking up. But I do think that, at least in terms of some of this market reaction, you're seeing, some of that fall there. The sentiment really is: are we entering a new trade war? Particularly, is the U.S. entering a trade war with some of its own allies in this case? So lots to really digest here. But I do think that uncertainty is really sort of coloring the mood today.
And we haven't even talked about Europe and some of the comments there just before he got on, the helicopter there earlier on.
Yes. So look, it's not particularly new, quote unquote, that Trump is saying that there's going to be some types of tariffs against the EU. But obviously, those remarks, saying that tariffs on the EU would definitely happen, drove European stock futures down. I mean, that's certainly, I think, kind of playing into this idea that under Trump 2.0 in this new Trump administration, nobody's really spared here. This isn't a narrative about the U.S. getting into tariff wars with its adversaries. It's a narrative that's developing about the U.S. getting into tariff wars with some of its own allies. And so it doesn't really seem like anyone's really being spared from that. That's obviously going to be a tremendous driver, I think, going into the European day today. Again, I think just without knowing exactly what all of that looks like, what goods are going to be hit, how some of these other nations might retaliate against new tariffs, it just kind of, really sets the tone that 2025 is a completely different world here. And it just seems like it's going to only get more intense.
To Jill's point, Steve, I mean, the China tariffs, relatively speaking, more restrained than some of the tariffs on U.S. allies, as Jill points out. To what extent are we seeing that reflected in China's response? And to what extent are there sort of parameters on what they can do here?
Right. So there are different areas that China can respond. Obviously, they need to respond to shield their own domestic economy, and that's where the currency could potentially come to play. Also, further stimulus could come down the pike at the National People's Congress coming up in about 1 month's time. So the markets, as we all know, have been waiting for some sort of fiscal stimulus or some sort of stimulus to boost the consumer, whether there's any support for exports. But then there's the retaliatory response to the external shock of these tariffs. Keep in mind that this is maybe not the beginning, or just the beginning, I should say. Maybe it's not the end of the tariffs. There could be further ones. He's threatened tariffs of up to 60%. There's also the review on the de minimis exports, the packages. That could be going away. So that's benefited e-commerce players in China. So there's a number of different things, but they can't do tariffs like for like because of the distortions in trade. There could be export controls further on key materials or minerals that China has large advantages in. They could make market access restrictions even tougher for some American companies. They could do their like-for-like tariffs, but it won't add up, right? And I think they do keep in mind that this is potentially, as you said, Jill, a 2025 theme that is not just ending with the implementation on February 4th, Tuesday. It is potentially much more coming down the pipe.
The notion that they need to do something politically is clear. How do they do that without kneecapping their own economy?
Well, that's the big balancing act, right? So Xi Jinping it started off with the Commerce Ministry talking about dissatisfaction and corresponding countermeasures. But we need to hear from Xi Jinping. But he needs to strike that balance as well. He needs to show domestically, politically, that he's taking a strong stance. But tit for tat again there's the potential of having a spiral down, drawdown impact on the Chinese economy at a time when it is not on solid footing. So, yeah, it's a tricky game. But keep in mind as well, trade war, if you want to call it trade war 1.0, was solely on China. This, as to Jill's point, they're going after their main allies and their main border partners, Mexico and Canada, the EU. That provides an opportunity as well for China to potentially sell many of the exports that were intended to go to the United States. Hey, sell much more to the European Union, sell more to Canada and the like.
Steve, thank you so much. Stephen Engel there, and Jill Deesis here, of course, rounding up the latest on these big stories that we're tracking at this point in time, to the point Standard Chartered was making earlier on here and shows this keeps the dollar bid over the short term. Subscribers can check out and read more about Trump's tariffs and how they threaten to disrupt the North American economy. That's the subject of today's Big Take. The terminal function for that is NI space Big Take Go. It's also available, Rebecca, on Bloomberg.com.
Yes, and still ahead on today's show, Kotak Mahindra Bank joins us to discuss the $12 billion in tax relief India's finance minister delivered in the nation's budget.
Yep, ahead of that, though, President Trump's new tariffs on China, Canada, and Mexico are set to hit U.S. households, raising the prices of products from food to cars. A closer look at what's next there. This is Bloomberg.
think in the short term, I think impact of the tariffs would be more muted because I think companies would already have stockpiles ready. But in the medium to longer term, I think impact would be particularly large because of the shifts in supply chains as companies seek to diversify their markets and look for new opportunities elsewhere.
It has a broad impact, but it's designed to specifically protect U.S. citizens and, really protect lives. So we'll see how that sets the table for the negotiating, that's likely to happen over the next several days, weeks, and months.
The tariff is at a lower level. It's at 10%, but it's universal. It's on everything coming in from China. And the president has targeted the de minimis threshold of $800 below being tariff-free. This has been a talking point for many years, and he's taking a look at that now.
Yeah, there we go. Some of our guests and colleagues reacting to, the big news on the weekend, President Trump's tariffs on Canada, on Mexico, and Rebecca, also on China.
Yeah, that's right. I mean, President Trump's tariffs on goods from Canada, Mexico, and as you say, China, really set to hurt U.S. households. Consumers are expected to be paying more for everything from fruit and vegetables to cars and electronics. I just want to take a look at that breakdown of some of these top U.S. goods imports. We'll look at China first. China focused much more on the consumer side, as we can see, mobile phones, household goods, electric appliances, as well as clothes, textiles, computers. Now, that's quite different from, say, if we turn and flip the boards to Mexico, where the emphasis much more on autos here. In Mexico, we're looking at car parts, trucks, cars, passenger vehicles, as well as, of course, some of those electric apparatus as well. And Canada, again, a slightly different story. On the one hand, we do have some of these vehicles and autos targeted, a few of commodities, but really it's crude oil that is, of course, a major factor here. And that, of course, has also been slightly limited. We had a 10% tariff that was broken out separate from this across-the-board 25% tariff that Trump introduced on Canadian products. So there's a little bit of reprieve here when it comes to specifically crude oil from Canada. Now, to break down all of that, let's bring in Khor, Chief Economist at the ASEAN +3 Macroeconomic Research Office of AMRO. Let's just start big. How much do these tariffs potentially cost the Asian economies and GDP growth this year?
Well, we did, we just launched our regional outlook forecast about 2 weeks ago. And at that time, we had not expected, Trump had announced that they were going to impose a 10% tariff on China. But that was the day after our launch. And at that time, we had assumed that Trump would impose a 25% tariff in the second half of the year on China. And our forecast, we shade down our forecast for the year for the whole region from 4.4% to about 4.2%. So we were pretty optimistic about the outlook for the whole region. We think that the region will be able to grow at about 4.2% this year and next year. And of course, now that Trump has announced the 10% tariff on China, we don't know which sector is going to hit. And it's going to be applied probably more sooner than the second half. But our view is that the impact of tariff will be maybe shave off growth by about 0.1%. So we'll probably end up with about 4.2 as well. It's just that the tariff is going to be smaller, but it's going to be sooner on China. And for the rest of the region, it's going to be quite small. But as you know, Trump 1.0 was basically directed at China. And we can see from the experience from the last 5 years that the most likely outcome is that there'll be a reconfiguration of trade from China to the other countries in the region. And so while China may be affected negatively, the other countries will be could actually benefit a bit from the redirection of trade.
Yeah. Do you think it'll work, though? Do you think Donald Trump's tariffs will have the intended effect of sort of the longer-term benefits that you just outlined there? And how long do we have to wait?
I think it's pretty immediate. I think the thing about the global market is that it's a very efficient market, and it tries to work around any obstacle that's in the way. So we expect that once the tariff comes, there's already front loading, as we all know, right? Once market expect that there's going to be tariff on the product, so we already see the spike up in exports in China and other countries in the region. And fortunately, the region actually is also, experiencing the uplift from the upswing in the semiconductor cycle. So that will continue this year, although it has already peaked, but it's still positive, and so they will continue to provide a lift for the region. So I think the impact of the tariff is usually distributional. So what you see is that export move from one country to the other in order to get around the tariff and go to the country the lowest tariff. So we'll have to see what happens next after the 10%, whether Trump is going to follow through with another other tariff on the region, and which country is going to be and by how much. But the main impact of tariff is basically a reconfiguration of trade. The reconfiguration itself can be quite disruptive in the short term, which is why I think most analysts are expecting that this is going to hit Mexico and Canada quite hard, because they might even go into a recession. But for the region, we are actually quite confident that growth is going to hold up quite well at about 4%. So but we have to see what happens next. It's a bit ironic because just a week ago we have DeepSeek, and there was a very positive technological shock on China, and that's a permanent shock. But the tariff shock, which is a negative shock, is actually quite cyclical, because over time, markets will readjust and reconfigure, and you have a new configuration of trade. In some sense, it gives rise to greater resilience, but of course, that's not the purpose of the tariff. We all know that.
Just quickly here, I just want to pick up on your point about this reconfiguration of trade that you're mentioning. Do you think, given that this time around Asian economies are expected to take a bigger hit when it comes to the trade war, can China offset some of the sort of limitations, effects of its exports, limiting effects to the US? Can it kind of offset that by re-diverting to, say, countries like Canada, like Mexico? Is that an effective strategy for Beijing?
Well, they will reconfigure, maybe not to Mexico and to Canada, but certainly, ASEAN might benefit from the reconfiguration of trade, we know that what happened with the solar panel, because a lot of the solar panel get shifted to Vietnam and Malaysia and Cambodia and some of the ASEAN countries, and then they were targeted again, by the Biden administration. So these things can happen, and in which case then you reduce the effectiveness of the reconfiguration. But the thing is, if you look at the US, they have to import those products from somewhere. The question is where, right? And at the moment, ASEAN is the most attractive destination for the relocation of supply, because ASEAN has a very strong manufacturing ecosystem, and they are able to take on the additional production very quickly.
The unintended, or I don't know if it's let's call it unintended side effects right now. What's going on is a U.S. dollar that is strengthening yet again. And earlier on, we just heard from the Indonesians that they are in the market to maintain stability and confidence in the market. The reason I bring that up is when I look across ASEAN FX, for example, should I expect officials to intervene to keep currency markets stable over the short term?
Well, it depends on the country to some extent. What I think the main thing is that inflation has actually come down to pre-pandemic level for almost all the countries in the region, except for some outlier. And because of that, actually, and because growth is still holding up well, the central bank have a lot of flexibility in how they plan to respond. And because the US dollar is strengthening against all currency, not just against any one currency, it's less of a threat. But in any case, we know the Chinese renminbi is very closely correlated with most of the currency there, and and the PBOC is, is moving to try to stabilize the currency, and that actually would help stabilize the regional currency as well.
Okay, I forgot to ask you this, and this is let's call it a theoretical debate here. Are tariffs inflationary?
Yes, we think so. I think this is one thing that I think the economist profession is united on. I mean, they don't agree on many things, but one thing they agree on is that tariff is inflationary. And so, we expect that, at the end of the day, the consumers are going to have to pay for it. But of course, it depends on the product. Where the product is where there's a lot of price elasticity and the importer can shift from one country to another, then you can expect that the producer in the country that's exporting the product that's subject to tariff may lower the price to some extent, and that would hurt the balance sheet to some extent. But overall, I think most analysts expect that the tariff will lead to higher prices in the U.S., more inflation, and that is going to hold the Fed back from cutting rates any further.
Right, and I think we circle back to the point you were making earlier on. Given how complicated these supply chains are, if they were complicated before the pandemic, even more so fast forward 3 or 4 years. The question I want to get is, to what extent can policymakers influence global supply chains right now? Or is that just, it's just almost an exercise that at the end of the day is just not worth pursuing?
Well, I think, there are market forces at work here, and the supply chain is, is a pretty efficient way in which the market, reconfigure trade according to, competitive advantage, but also the tariff barriers and all kinds of sanctions, So, I think definitely policymakers, will try to take advantage of this in order to, stabilize the economy, especially in the ASEAN region. I think the Trump 1.0 actually has benefited some of the countries in the region because there's been a lot of FDI inflows into the region, in some sectors, and also I think longer term we also have to remember that ASEAN is a rapidly growing region, with a strong middle class. And growth there is going to be sustained pretty much also by domestic demand as well, and also investment from outside. If you look at China's trade with the U.S., it's come down quite sharply, the export to the U.S. In terms of share of the imports, and China's export to the rest of the world is now much larger than the export to the U.S. So I think there's going to be that kind of reconfiguration of trade, right, from China to the U.S. to the rest of the world. Right. And then the rest of the world, initially may, of course, reroute the export, but eventually they're going to develop the capacity because the Chinese investment are going to move in and start producing in those countries as well.
Khor, thank you so much for joining us today. Chief Economist there at ASEAN Plus 3, of course, Macroeconomic Research Office at AMRO. Okay, just a market update here. So risk assets are offered. That puts it nicely, including this group right here, crypto, hitting a wall substantially today. This is Bloomberg. When the chips fall, 2.5% on Samsung. TSMC is also coming up with your screens very shortly. This catch down trade on the DeepSeek conversation on the TSMC story. Broad risk aversion playing through across Korean markets, and also, as you can see on Samsung, there's also some political stories involved here, which we'll get later on. Down about 6% on TSMC. Japanese car makers going into the lunch break over in Tokyo, which I guess is really a very good cross-section of, how complicated supply chains are. Just look at car makers. We're off substantially on these names. This is Bloomberg.
11:29 a.m. in Tokyo. Japanese markets about to go for their lunch break. Let's take a quick peek at what is happening. Nikkei down, first negative day after 3 positive trading sessions, about 2.5%. Topics just a little bit behind it at 2.7. And of course, that story about dollar strength on the back of what the US Donald Trump's tariffs coming through, reflected there in the currency. And elsewhere, Dave, what else are we looking at? It's a pretty rough day, as you say, when the chips fall.
Yeah. I was actually about to stop you there, but, you know, why not? Why not? Why not throw vinegar on this wound? 2.7%, every single sector is down. Everything from IT all the way through to healthcare. Yeah, it's not a pretty day to be out there. It doesn't help as well that you have one market that is, I guess, has D1 stock when you talk about tech in the region recently that is coming back online, so that's a mechanical price. It doesn't look like it's going to be a pretty day in the U.S., and we're looking at U.S. futures right now down about 2%. And, you know, if Donald Trump wanted a stronger dollar, he's getting it, really, today, 1.2% to the upside here on the Bloomberg dollar index. For how markets are reacting to this, and are there any opportunities to entertain today? Mark Cranfield is with us right now out of Singapore to take us through his thinking. And, yeah, Mark, on a day like today, do I stand on the sidelines, or is this a buying opportunity?
Well, if you're like the retail investors in America, you'd be buying into this dip. That was one of the strange things that we saw last week, was that even when NVIDIA was having a huge sell-off last week, retail participation was stronger than ever. They were very big buyers of NVIDIA and some of the other tech stocks as well. Now, that could well start to unravel. One of the things that we're seeing today is that cryptocurrencies are selling off across the board. Some of the selling is very severe. Some have been down almost 20% today. Bitcoin itself is doing better than most, but some of the smaller coins are doing very, very badly. And this smells a bit like retail capitulation, where they're selling investments in crypto to make up for losses they're expecting to take somewhere else. This is not a good signal for what could happen in the US markets later today. So that retail dip buying we saw last week might completely go the other way today. So we might actually see a re-acceleration of people having to take losses on various things. That may be the warning we're seeing from the crypto markets this morning.
I want to pick up on your point there about this potential warning that we're seeing, the interaction of retail investors in this space. I mean, can you just sort of look into the future for us? Where are some of these potential nasty surprises? What are the things that we might see that are maybe hard to predict factors that might be disruptive?
Well, certainly one major narrative which really is going to be threatened here is the US exceptionalism one. So you're seeing the issues coming out from the new White House is that they want to put America first. So that's the theory behind a lot of these policies. They want to protect and insulate the United States from the rest of the world. The problem is that US markets are by far the biggest and the most committed markets that we have on the planet. And financial investors move their money around very, very quickly. So if they see risks to general performance, if they see this is the beginning of a tariff war, which is going to get retaliation from other countries, it's generally going to dampen global trade. Bloomberg Economics think that already 1.2% will be knocked off of US GDP, and that's just on the first wave of what we've seen. It could get worse. Now, if that's the assumption that investors start to take globally, the idea that US equities and other US assets can outperform, as they have been in recent years, that massively comes into question. So if you start to threaten the superiority of US equities especially, that has very widespread consequences. And there you get a complete pullback from what Donald Trump is trying to do. So much for isolating the United States. He could actually be making the equity market situation worse with some of his plans here. The chances of us getting whiplash in terms of contradictory messages, people retaliating, changes to the original tariffs going in is a very high risk. That what we see today is just the beginning, and traders will have to expect highly volatile days for quite a long time yet.
And Mark, so we have two things happening today to the point you were making earlier on, right? So last week, U.S. investors, retail investors came in and bought up that NVIDIA dip as an example. The proxy there in the Asia Pacific is TSMC, and it's playing some catch down. I think a chart's going to come up. It's actually right now on this key support level where that's actually held. If the U.S. exceptionalism narrative is challenged, what is the alternative? Is it an Alibaba story that is moving against the grain today in the Asia-Pacific. Might that counterintuitively benefit Chinese markets that have been waiting for a catalyst, really?
What the investors in Chinese markets especially want to see, they want to see this, the new tariffs against China as being the thing that galvanizes finally, we get the big bazooka in terms of policy stimulus out of China. So we've always seen some moves last year. Some of it did quite well for the markets. A lot of that has been unwound already. And now we're sitting at a situation where investors want more. Some people will be hoping that this is the turning point and this is the chance for you to buy into China, because China is going to go its own way. China is going to protect itself. It's going to stimulate on a huge scale, and they're going to cut the interest rates, and they're going to do everything to protect the Chinese economy and boost Chinese onshore assets especially, which obviously will feed through to things like H-shares as well. But that remains to be seen. You can bet that investors will have a very short degree of patience. They'll be hoping that that happens, but they won't stick around for a very long time to find out. And don't forget, in the background, you've got the yuan as well, which is pushing towards some of the weakest levels we've seen for more than 2 years. They need to contain that as well. There are many moving parts here, but China could be an outperformer if finally the Chinese government get the big bazooka out and prove to investors they really mean business. This time, they're going to do whatever it takes to boost the economy.
Mark, I just want to ask a quick one. Your point on the currency there, the offshore yuan near that record low. Are we expecting, or are investors expecting, to see intervention this week? Could it come through via the Hong Kong market? Obviously, we know onshore is off for another 3 more days.
Well, if you look at the way that the dollar against the offshore yuan has been behaving this morning, particularly in relation to the wild moves you're seeing in other currencies, I suspect that stealth intervention is already taking place. It doesn't make sense for the yuan to be outperforming all these other currencies, given the fact that China was included in this. They may retaliate, and there could be more to come. So I suspect that already there is somebody in the background helping to give some support to the yuan.
OK, Bloomberg MLive strategist Mark Cranfield there. And you can follow along with more on this story and all of the day's trading on our Markets Live blog. That's on the Bloomberg at MLive Go. You can get a market rundown in 1 click, and there's commentary and analysis from Bloomberg's expert editors, Mark Cranfield and beyond, and find out what exactly is affecting your investments on this very, very full day.
It feels like a Friday, doesn't it? Anyway, coming up, we're talking about India. The budget's out, $12 billion for the mid-class here, the tax cut in a bid to boost consumption and spending. Analysis just ahead. This is Bloomberg. But sprinkle in a bit of this tariff story and this strength in the dollar. So we're hearing from the Economic Affairs Secretary Ajay Seth. He's talking in an interview right now, just talking about how the dollar appreciation has thrown some challenges here, and that the RBI will continue to take care of a lot of these gyrations we're seeing across these markets. If you're just joining us right now, the tariff story has really put a rocket underneath the U.S. dollar today. And as we move into the thick of, well, the Asian session, moving into the Middle East, and as we make our way into Europe, you look at the likes of cable, for example, down about 1% last we checked earlier on. We're 2% away from parity on the euro, and we get to a point where, as Donald Trump just said about an hour or so back, that, yeah, you guys are talking about Canada and Mexico. Europe's coming up next. So that's nothing new as an idea, but certainly with markets this sensitive to headline risk, if and when that headline drops, and a counter from Europe, if and when that, in fact, then comes, don't be surprised if parity becomes the next headline to talk about here, Rebecca.
And one of the risks here when we talk about headline risks has really been because actually there has been this uncertainty over precisely what we're going to see when these tariffs come out. Of course, you know, we had Jill Deesis and Stephen Engel earlier talking about how well telegraphed some of these, curbs are. But actually, there wasn't necessarily this expectation that they would be as broad-based as we've seen them, or that there would be as few exceptions. We had an exception, for example, for Canadian crude oil, but pretty much other than that, they were much, much broader than I think some were expecting.
Yeah, the casting that net earlier and wider than expected, I think. And, our economists, they've put out their scenarios, actually, but there's a caveat there for our Bloomberg clients. When you look at the reaction from Bloomberg Economics, look at China, you can do as much scenario analysis as you want. There is so much uncertainty when you try and model tariffs because of how complicated and how many moving parts there are there to just put everything together.
And there's an interesting contrast here with the India story, because India, of course, unlike the US, really juxtapositioned here, has been seeking to lower its tariffs. So sticking on that theme, Indian Prime Minister Narendra Modi's government has given middle-class consumers some $11.5 billion in tax relief in its latest budget in a bid to shore up its economy amid growing global risks. But there was little direct support for the millions of unemployed. Let's now go to Bloomberg Insight anchor Haslinda Amin, who's in our shiny new Mumbai studio, standing by with our next guest.
Well, that's right, Rebecca. We're pretty excited about this shiny new studio, and what a perfect way to kick off conversations here. In India, you talked about how that budget came up on Saturday, and there's been a lot of reaction. Let's get perspective with our guest, Shanti Ekambaram, of course, Kotak Mahindra Bank Deputy Managing Director. Shanti, good to have you with us.
Hi, Haslinda. Thank you very much, and congratulations on the new studio.
Thank you. We've been talking about the budget, Shanti. I mean, to what extent do you think that budget is insulating the Indian economy from all the things that we're talking about today, like the tariffs from Trump?
So I think you should actually say the two are a little delinked. What was the need of the hour in India was really growth was slowing down, led by consumption, particularly urban consumption. And I think the finance minister did what she could with what she had, which is put money in the hands of the people. So about 1 lakh crores by way of tax rationalization has been put in the hands of small, mid, large, everybody, right up to the tax slabs. Money has a multiplier effect. It will do 3 things. A, it will boost consumption, which is very much needed, and consumption has a multiplier effect. Hopefully increase savings and investments as well, which is important for financialization of the market. So the way I would say is, within the given framework that the finance minister had, she did what was right and what was needed for the economy. At the same time, what is important is they committed to fiscal prudence. It's very easy to blow the fiscal lid by saying, okay, I'm going to give some more subs for investment, I'm going to blow money. But they committed to a fiscal discipline of 4.4%, which I think was very important. There are many other small things which are outstanding, but for me, the 2 things was putting money in the hands of the people, which will be a multiplier effect on the economy, and sticking to fiscal prudence, which is very important from a long-term stability and growth of India.
The question is that enough? You talk about the 2 being unrelated, but the tariffs would mean slower growth for the world. It could also mean slower growth for India if there's less demand for the products that it's trying to sell to the world.
So the way I'd look at it is, yes, the global tariff storm that's going on is very important. But India is still almost 90% domestic, 90 to 92% domestic. So addressing domestic consumption and growth, I think, was more priority. In my mind, I think as far as tariffs are concerned, it's something that 2 countries deal with each other, right? I mean, India's just 8% of its GDP or so is exports. And, US is a large trading partner. But at the end of the day, what is Mr. Trump saying? He's saying, you give some, you take some, right? So countries have to learn, he said, buy a little more from America, buy, this thing, be a little more open to American goods. So I think it's an engagement between 2 countries. Yes, it's important. India has not yet been announced, but I'm sure that, there will be a discussion happening. But the need of the hour was to address Indian growth and consumption while keeping an eye on international. For example, opening up of the insurance sector to 100% foreign ownership has been the ask for a long time. It was announced in the budget, of course, with the proviso that you invest the premium back into India. To me, that's positive.
But Shanti, take a look at the impact in the markets. The Indian rupee already hovering at record lows, and now with the dollar expected to go stronger, the rupee will be under a lot of pressure. Bearing in mind as well, the RBI is set to cut rates this year. This month, in fact.
Yeah. So the way I look at it is, rupee was the strongest currency. Just go back 3 months, Haslinda. Go back 3 months, rupee was the strongest currency that you could find amongst the Asian peers and even in the world, right? Because India was growing strong and India was, had its both fiscal as well as the monetary policies very stable. In fact, there's a point of view that rupee was overvalued. If you go on the REER basis, rupee needed to have depreciated, right? At the point at which in India is, I think the RBI has decided to let the rupee depreciate in line with other currencies, right? At the stage at which India is, rupee depreciation is not a bad thing, right? And when you have such a strong dollar, right, and currently likely to remain strong given all that you're hearing, it was but natural that the rupee depreciated. But the rupee held out the longest as far as you can see. It's competitive for India's exports.
Rupee depreciation coming at a time when oil prices are rising. Surely that must put a dent somewhere in India's economy.
So the way I look at it is, oil prices were rising, but the rupee held out. Actually, oil prices have stabilized if you look at the last few days. You know, it's volatile world. But India is dependent on oil and there's no giving way. So I'm saying that it's economics at the end of it, right? If you have a very strong rupee and you're not going to attract the investments, right? And if you're not going to be able to, export, because a very strong rupee is also an export deterrent, it's a balance. And I guess you have to play the balance. You talked about interest rates. I also expect a 25 basis points rate cut. But I think that's very important to, really kickstart the whole feel-good and the consumption cycle in tandem with the fiscal policy that has announced money in the hands of the people.
So lots of optimism, Shanti. The question is, can India get back to 8%? Was 8% a blip? Is the new normal for India's growth perhaps 6.5%, at most 7%?
So at 6.5%, 7%, we'd still be on top of the world? Tell me which economy is growing at 6.5%, 7%. Yes, India needs to grow at 7.5%, 8%. But at 6.5% to 7%, we would still be on top of the world as far as growth is concerned. And that is exactly what needed to be addressed. And that is what the finance minister has done. So I think lots to do. Okay, we need to kickstart private investment. We need to sort of attract more capital. We need to do more things, but one step at a time.
But we also need to address unemployment. At 40%, 30% of those unemployed among the young people are actually graduates. This, some people say, this budget did not address that, did not open the way, the path for more jobs in the economy.
I don't entirely agree. First, I agree that jobs are very important for a country like India, which is getting more educated, which has a lot of people. But I think if you look at the measures that were announced for agriculture, MSME and exports, MSME and agriculture probably together employ almost 70-80% of India's population. It's done 3 things. It's sort of talked about increased productivity in agriculture, which employs almost 50-60% of India's labor. MSMEs, which account for a large amount of the employment. And third, the export sector. For the first time, you're seeing many measures for the export sector, which again will spawn entrepreneurship. India is not just about employment. India is about the largest startup ecosystem. And I think there's a lot of push for more entrepreneurship, innovative, in cutting-edge fields as well. Yes, I think a lot more needs to be done as far as employment is concerned, but Make in India, PLI schemes, they all aid towards that. And I think some of these measures to kickstart large parts of the industries which employ large amounts of people is very important. I remain optimistic.
Great insights and great optimism there. Shanti Ekambaram, Deputy Managing Director at Kotak Mahindra Bank. And Dave, of course, she says, don't sweat it. Tariffs may be here, but given that the economy is driven pretty much by the retail investors here and consumption is about to pick up, there's nothing to worry about.
Yeah, I mean, 6.5%, right? A lot of economies would scramble for anything close to that, particularly when you look at some of these projections right now coming through from economists, ratcheting down their expectations because of the tariffs. As Linda, of course, fantastic interview there. Of course, lots were coming up from our brand new studios over in India, and more in the budget coming through on Insight. Joining, in fact, Haslinda in a couple of minutes is India's chief economic advisor, as well as the former CEO of HDFC. This is Bloomberg.
Welcome back to the China Show. President Trump's 10% tariff on Chinese imports is a focus of Chinese media today as we look at what's trending in China. The China Daily editorial says that Trump's levy hike will leave no one unscathed, adding that the economics and trade relations between both countries should be beneficial. It also says that China has worked to control fentanyl-related substances and that the U.S. should view its fentanyl crisis as a domestic one.
Meanwhile, you have the Global Times talking about what it calls trade coercion. It won't fix the drug issue. Its editorial says that the fentanyl crisis won't be fixed without eliminating demand, and that tariffs, of course, coming through one way against other WTO members will not actually address the root cause.
And a commentary posted to WeChat by Chinese academic Yingping Guang also describes the U.S. fentanyl issue as a domestic one, echoing some of those commentaries that we've seen elsewhere. The Shanghai University of Business, International Business and Economics professor says the root cause lies with the U.S., but that Washington often blames its domestic crises on foreign countries. He describes the tariff moves as a case of the U.S. being sick, but asking China to take the medicine.
Why do I get the feeling this tariff conversation's a bit political? Casino stocks. Let's have a look at markets right now. So there's the revenue miss in January, but also, of course, the politics-driven risk aversion we're seeing in markets. So we're down across casino names. This one actually also quite political. Some of the Panama-tied stocks, and of course you have, there, CK Hutch in Hong Kong. Plus you have comments coming out of Marco Rubio and additional comments coming out of President Trump saying that no, there's no need for the military to get involved there. Seng Index is down about going into the last 60 minutes of trade, and also crypto-related stocks. In case you missed it, Ether was down as much as 26%. So cryptocurrencies are off and off substantially this. What day of the week is it?
God, it's only Monday. It's practically still Sunday for some of us.
Yes. Get me back to bed, please. Markets falling out of it.
We'll be here all week.
Yes. Lucky you guys.